already seeing massive increase in green and renewable energy type of demand for silver. And let's not forget, we've depleted all of our artillery, lots of it, sending it off to the Ukraine. And as I've said many times before, Google it, almost exactly 500 ounces in the tip of every Tomahawk cruise missile. So when you're talking about, advanced weaponry and guidance systems, it all needs silver too. So between military and industrial and monetary demand, it's off the charts. Ultimately, when that happens, I think it really, you're going to see a squeeze on the COMEX and a squeeze on the LBMA, where everyone rushes to take what is available before it's not.
Miles Franklin Precious Metals CEO Andy Schecman and financial analyst Bill Holter offer valuable insights on the current financial system. Schecman focuses on silver depletion due to advanced weaponry, underlining supply pressures. September silver futures bulls have the overall near-term technical advantage. Silver bulls' next upside price objective is closing prices above solid technical resistance at $26. Industrial demand for silver rose by 6% in 2022, reflecting sharp increases in its usage for photovoltaics, consumer electronics, and silverware. Silver prices are projected to increase by 6% in 2023 amid continued high demand, before falling 4% next year. Schecman predicts rising demand pressuring Comex and LBMA due to commodity scarcity, while Comex Silver encounters resistance near $25.80 trendline. Recent data from Friday revealed that Comex Silver speculators raised their net long position in the week ending July 18th, indicating a bullish sentiment towards silver. For the week, the dollar index surged more than 1%, while Comex Silver registered its first weekly decline since June 26. Holter stresses unprintable commodities' importance such as gold, silver, while Andy underscores bail-in potential, spurring banking risk awareness and driving gold, silver demand for wealth safeguarding. Precious metals have rallied in the last 3 months following a dip in prices at the beginning of 2023. The World Bank's Precious Metals Index increased by 9% in first quarter of 2023, driven by a weakening U.S. dollar, geopolitical tensions, inflationary pressures, and increasing economic uncertainty. Strong industrial demand also played a significant role in lifting the price of silver and platinum. We will now bring you clips of Bill Holter and Andy Schecman from their recent interview with Arcadia Economics. Before we proceed further in this video, please make sure to subscribe our channel and click the bell icon to stay updated.
Well, it'll probably all happen at the same time. One will trigger the other, whether it's a financial problem triggering a failure to deliver, or is it a failure to deliver that causes the financial problem? It's hard to say. But as we talked about before, you can't print gold, you can't print silver, you can't print oil, wheat, etc. And once the financial derivatives lose sway, and again, whether it be because of supply and demand or for whatever reason, once the derivatives break, I mean, you could see many commodities that double, triple, quadruple in price literally overnight, simply because the financial cushion, if you will, of the derivatives suppressing the price is gone, and then it's discovered that the supply doesn't exist. So I mean, it will all end up in a failure to deliver in many different commodities. But the question is, the chicken or the egg question. Is it the failure to deliver that causes the financial problems, or is it the financial problems that cause the failure to deliver? It really doesn't matter.
I would think it's the financial problems that cause the failure to deliver. The realization, again, pointing to a bail-in. If we see a bank bail in, you're going to see mass hysteria where people who never would have thought about gold and silver are saying, holy shit, I need out of the system now, out. And that was what it was like when these banks were being bailed out. When they're bailed in and people understand the systemic nature of one bank pulling down several others, we haven't even talked about the insurance companies in that environment, but or the brokerages, but and so yes, I think that will on the physical demand side, from retail side or from the investment side, I think that's enough demand to sway the tables dramatically.
I actually think that the lower prices, the lower premiums has brought some people into the market.
I agree. I agree very much. We've seen an uptick over the last week or so, 10 days, noticeably. But it hasn't had any effect whatsoever on the premiums, which have leveled off, and the demand hasn't pushed them up yet, I guess is what I mean.
Referring to historical cycles, Bill Holter points out Fed's tendency to create bubbles with rate adjustments. October 1982, inflation had fallen to 5% and long-run interest rates began to decline. The Fed allowed the federal funds rate to fall back to 9%, and unemployment declined quickly from the peak of nearly 11% at the end to 1982 to 8% 1 year later. The Federal Reserve is expected to lower interest rates in 2024, according to a number of economists and market analysts. The Fed has been raising interest rates since 2022 in an effort to combat inflation, but inflation has remained stubbornly high. During the interview, Schecman also points out the notable occurrence in March and April Silicon Valley and Signature Bank collapse attracted 14,000 new clients within 45 days. Let's get back to interview.
The Fed may be forced into QE. I mean, they may not get a chance to do that on their own. They may be forced into QE by financial conditions, by failures to deliver, by defaults on whether it be commercial real estate projects, banks themselves, insurance companies, brokers, what have you. I think it's very likely that the Fed will have their hand forced. I mean, look, let's go back to 1982 when rates peaked out. Every time the Fed lowered rates, they created a bubble. They started to raise rates until they broke something, and then they were forced to lower rates again. That cycle is still going, except this time rates are much higher than when they were at not much higher, but they are higher than where they were during the last hiking cycle.
Yeah, but then also we had a surplus, not a deficit, and the world reserve status wasn't being challenged or called into question. Am I right on that?
We haven't had a surplus since 1960. The trade deficit and the fiscal deficit as a percent of GDP was much lower years ago, but it was a deficit.
It was well under $1 trillion, right?
Yeah, I think what was it, in the 70s or around 1980 was the first $1 trillion.
And by the way, we've added I want to say $1.8 trillion
in 8 weeks.
In 8 weeks, so 1.2 or 3, over $1 trillion in 8 weeks. It took 209 years to do it. Last time we did it in 8 weeks, so it's accelerating. And if they lower rates, what does that say to the rest of the world about desire to hold dollars that are now we've acquiesced and gave into inflation and interest, and we're just forgetting about it and trying to salvage the markets? I think you're damned one way, if not the other. So that's kind of the whole big picture that's hard, even if you get part of it right. What happens as a result or the consequences of it, what we saw in March and April with Silicon Valley and Signature Bank brought in 14,000 clients in 45 days. That's 4 years worth of clients. I mean, it was an event that really I'd never seen before, because it's one thing for us to talk about the markets, the stock market, the bond market, real estate market, the dollar. It's another thing to say that the place that you've gone to bed every night thinking, geez, well, at least my money's safe in the bank, to say that that's not safe anymore, to say that that's systemic, to say that that has real big problems. And that happened with Janet Yellen doing what she wasn't supposed to do, bailing out the banks. And of course, it wasn't at the expense of the taxpayers, so we're told, right? But wait until they get bailed in, because during the Dodd-Frank, or as a result of the Dodd-Frank law or act, bail-ins are now written into law. Bailouts are not supposed to happen. And when you see bail-ins happen this time, that's how fast things change. When people lose their money this time and are bailed in, anything over the $250,000 FDIC level, I think it becomes a whole different level of panic. But what we saw in March and April was 6 months worth of business, really. So it's kind of skewed in a respect. But we're way ahead of last year, which was the biggest year by far that we've ever had in over 30 years.
And it'll only take one bank. Will only take one bail-in. Once there's one bail-in, you're going to see an absolute run
Mhm.
because people are going to wonder if their bank is next.
The precious metals market is gearing up for intriguing changes. Silver's future is uncertain with rising industrial demand and interest in wealth protection. Recent surges, driven by geopolitical tensions and economic uncertainties, hint at an exciting path ahead. What's in store for silver and beyond? How will the interaction of industrial demand, economic conditions, and investor sentiment influence the future of silver and precious metals? Share your thoughts in comments section below. If you find this video informative, don't forget to show your support towards our channel by giving this video a thumbs up and subscribe to our channel, and turn on notifications to stay informed about our latest videos covering more interesting topics. Thank you for watching.